Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, 2nd of June. The market narrative continues to swing between the ugly geopolitics of the Middle East and shiny technology news, but technology enthusiasm outweighs the price action in the market, with investors rushing in to taste a part of that cake. But as they do, the risks spill over the entire economy through different channels. So we will talk about all that and more, but before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So when you think that the geopolitical headlines could not get worse, well, they do. Yesterday, the news went from Iran suspending the peace talks with the US due to intensified Israeli attacks into Lebanon, sending oil prices up to past $95 per barrel level for the US crude. Then Donald Trump came up with the soothing news that Hezbollah and Israel finally agreed not to fight each other in Lebanon. But then Netanyahu contradicted the US president by saying that fighting in southern Lebanon would continue. It's a mess, really. I won't engage into a discussion regarding the US-Israel's political goals here because I am not a geopolitical expert, and even geopolitical experts have little explanation to the situation other than Trump having been fooled by Mr. Netanyahu into this mess. But oil experts told OPEC Plus that even when the Strait of Hormuz will be opened, supply disruptions due to this prolonged closure of the Strait of Hormuz and the damage to oil infrastructure will persist. Price-wise though, I would say that the latter, the reopening of the Strait of Hormuz, would mean lower global prices immediately, potentially some pressure on oil companies' earnings as well as a result of it. So this morning, US crude is slightly lower than yesterday, hovering around the $92 per barrel level for the US crude. Short-term risks remain two-sided. It is possible that the barrel of US crude rebounds past the $100 per barrel psychological level if peace negotiations stall. But it is also possible that we see the price pull back toward and below the $80 per barrel level if the Middle East fighting ends. Yet given the rapidly falling global oil reserves, the next leg up threatens to push oil higher than the $120 per barrel mark if we remain into this situation of uncertainty for a few more weeks. Above that level, however, demand destruction would keep prices capped. So unless the war extends into July, I wouldn't expect the prices to rise to $150 to $160 per barrel levels as suggested by some industry leaders. And looking at oil stocks, they performed well yesterday on the back of a rebound in oil prices, yet the initial impact of higher oil prices having been already priced in, and in the light of prolonged period of supply disruptions, we could see SPDR's energy ETF step into the medium-term bearish consolidation zone that would require a move below the $55 level, which would also coincide with the 100-day moving average. Now zooming out, the S&P 500 rose yesterday to a fresh all-time high level, led higher by technology, of course. Nvidia jumped more than 6% yesterday after unveiling a new super chip for PCs. Jensen Huang said it was the first big reinvention in 40 years. The new super chip aims to allow large AI models to run directly on a Windows computer instead of sending requests to a data center and getting them back. In other words, Nvidia wants to turn every computer into an AI machine capable of handling complex tasks across your programs and files. This is just fantastic for AI adoption. It means faster responses, lower cloud costs, and greater privacy. Think of sensitive data that no longer needs to leave your device. For medical and legal industries, for example, the latter would be just a game changer. And for data centers, it wouldn't be a worry. On the contrary, companies would face less capacity constraints, and demand will remain robust in all cases because the most advanced AI models will still require enormous computing power to train and run, and that's something that only data centers could offer. So if anything, putting AI on every desktop could accelerate adoption and finally increase demand for the cloud infrastructure behind it as well. So it's all very much exciting, and Nvidia has just opened a fresh revenue avenue for itself yesterday, justifying obviously investors' enthusiasm. But HP, Dell, and Lenovo also gained between 6 to 10% since yesterday, and the continuation of their almost vertical ascent since a few months now. AMD and Intel, on the other hand, fell on rising competition for PC chips, while Microsoft advanced more than 2% after unveiling the first Windows PC to run on an NVIDIA main processor. Well, that's about the fascinating chip war. Interestingly, the news helped TSMC only 1% higher in Taiwan today and couldn't help Kospi Index extend gains. Investors apparently preferred pocketing in some of their profits on the back of worsening geopolitical outlook. But besides NVIDIA, the big news came yesterday from Anthropic, which submitted draft paperwork for an IPO this fall, aiming to leapfrog OpenAI, which is also expected to file for an IPO in the coming days. As we discussed in a special episode previously, if you haven't watched, just go and watch it. Well, the valuations are huge for these ultra promising but cash burning companies. And what's perhaps more interesting at this stage is that the AI race is no longer being funded solely by venture capitalists willing to lose money for a decade, for example, in exchange for a shot at changing the world with these AI machines. The financing is becoming increasingly institutionalized. Just yesterday, Alphabet announced plans to raise up to $80 billion to fund its AI ambitions. That was one of the biggest stock deals in history, and that included a $10 billion investment from Berkshire Hathaway. So it simply means that the AI is increasingly becoming a credit story as well. And the deeper traditional finance gets involved, the more the AI story shifts from a technology narrative to a credit narrative. So what's the risk? A failure, God forbid, would not likely trigger a financial stress, but the growing web of equity investments, debt financing, private credit facilities, infrastructure spending, and long-term purchase commitments mean that AI-related losses are increasingly finding their way into pension funds, insurers, asset managers, corporate balance sheets outside AI and technology, and the broader economy. So basically, we are all in the same ship today, and we're all trying to go to the moon. Now, of course, the S&P 500 earnings are expected to accelerate 24% this year on the back of this AI enthusiasm and spending. Goldman Sachs single stock 1 month put call skew fell to the lowest levels on record, meaning that there are only bulls left in the market. No more bears, just bulls. And two charts from Axios warn that corporate profits now make up around 12% of gross domestic income in the US. That's the highest since 1950s, while compensation going to employees fell to 51%, meaning that we are now in a two-speed income growth for US households. Those who invest versus those who do not. And needless to say that corporate earnings are rising on AI. If you take out technology, the earnings growth and stock prices are much less impressive. So in conclusion, to be well off, one must invest. But because everybody is in, the valuations are exploding as well. AI will survive as the internet, but the question is, could the AI rally avoid a road accident like the dot-com bubble burst in early 2000s or not? Now, no one has the answer, but the risks are clearly building. Now, one last thing before we go. The dollar yen is under pressure this morning as the Japanese authorities have started to warn that the pair is now getting close toward the uncomfortable levels that could soon require a direct FX intervention. The recent history of FX interventions show that the repeated FX interventions in the dollar yen have not helped reverse the yen's selling pressure, but they have well been fruitful for the tactical short positions waiting in ambush today to catch the next intervention led leg down. Just saying. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.